Welcome to the Capital News. I'm your host, Alex Karitis. Today is Sunday, February 7th, 2021. Thank you so much for joining me. Title of today's podcast, January 2021 Jobs Report. I took Friday off and did say that I was going to get to it this weekend, so here it is. Not the best of reports, but that's sort of par for the course, what we've been witnessing with respect to initial jobless claims for the past year, really. I mean, I'm hesitant to say past several weeks where they've been trending upward here and there. Came down last week, 779,000. Still a very bad number. Still over 100,000 higher than where we were during the depths of the Great Financial Crisis. And during the Great Financial Crisis, we only saw 650,000 for a week or two. In a few short weeks, we're going to be living with these types of figures for one full year. And there's no end in sight. In fact, we now have Treasury Secretary Janet Dingbat Yellen coming out over the weekend. No surprise here at all. But pushing further for their $1.9 trillion stimulus package. So let's understand this. We have a several $1 trillion Nobody Cares Act passed last year, which I warned against. We then had the Nobody Cares Act 2.0 bill that was passed before Donald Trump left office, $900 billion. And paired together with that $900 billion monstrosity was a spending bill of $1.4 trillion just to keep the lights on for a few months, which we're already getting there because that was passed in December. So we're already well into the first few months of the year. So they're going to have to go back and pass more spending to begin with just to keep the lights on. But it's never enough. We haven't even gone through the whole $900 billion. We still haven't gone through the entirety of the first Nobody Cares Act. A lot of that money is still being hoarded, if you will, by various players who have received it. Wonder why? Well, we've had those conversations. Banks getting a lot of this money with the purpose of assisting small businesses, not doing it. Not doing it. Those small businesses have too much debt. They're not trustworthy. The economy's slowing down. They're never going to be able to pay this back, yada, yada, yada. We're not getting enough fees by lending this money out, so we're not going to do it. But, of course, they'll keep it. They'll commingle it with their investment funds, and they'll trade with it, and they'll make record profits. But there's nothing to see here. Again, that's why it's called the Nobody Cares Act. Now, it is Sunday, so I do want to talk about some market performance just with respect to some of the cash trades taking place over, obviously, in Asia, and then just some of the futures markets here for the U.S. markets, too. But when we look at the stimulus, the 1.9 quote-unquote stimulus, $1.9 trillion, divided by 330 million Americans, roughly, would give every American a check of about $5,800. $5,800, a family of four. What is that, $22,000, $23,000 per family? So where's all the other money going? Because these checks this time are supposed to be means tested, so it's not going to be for the entire lot of 330 million Americans, and it's going to be about $1,400. So where is the remaining $1.5 trillion going to go? Small businesses. Well, that's what they'll tell us. It's not going to make it, because we know this from the PPP loan garbage. We know this because the banks are hoarding it. This isn't tinfoil conspiracy hat stuff. This is what's told to us by the banks themselves, by Jay Powell, the chair of the Federal Reserve. They say this openly. The Small Business Administration tells us where the money went, the vast majority of it, and it wasn't the small businesses. That's why on last count, a couple of months ago already, of the small businesses remaining, nearly 50% were still concerned that they were going to have to end up closing their doors for good. 50%. That was from a couple of months ago. So even if you took now, so understand that, 1.9 trillion, 330 million Americans, roughly $5,800 checks to every single American. $1,400 checks times 330 million Americans, again, assuming every American gets one, $462 billion. So again, I ask, where is that extra $1.5 trillion going? How much more money do we need to spend on COVID stuff? Where's that money going? Well, how is that all to account? It isn't. It's a simple answer. How many more tens of billions of dollars do we have to give to the likes of Pfizer and other major pharmaceutical companies. How much more remember the Republicans and Donald Trump were supposed to stick it to them. Remember, we're gonna screw them over. We're gonna get them prices down. They're making windfall profits, and of course they can't be sued if there's adverse effects due to the vaccines that they're pushing out. Now I understand that from a business perspective, but I'm just telling you that's what the situation is. You can't sue them. So what happens if there's an adverse effect? Because it was Operation Warp Speed. They were pushing this thing through. I understand. Can you sue the government then if there's adverse effects because they were the ones who were pushing Operation Warp Speed? Good luck with that if something happens. All I want to know is where all the money's going. That's all. And why do they keep pushing for more? And the new selling point that Janet Yellen is now pushing, these are the same scare tactics that they used during the great financial crisis to justify all of their bailouts then. Well, if we spend the $1.9 trillion, we'll get our unemployment rate back to where it was prior to the pandemic, which of course is at odds with the Congressional Budget Office that says we're not going to get back there until the end of the decade. But just another $1.9 trillion is going to do the trick. It's going to save so many jobs. How can that be? When we continue to see over 700,000 Americans filing initial jobless claims, if all of these programs were working, we wouldn't be this high on initial jobless claims. But we are, because they do not work. You can print money. You cannot print jobs. Been saying it here for a year now. With some market performance, the dollar index 91.04, a little bit of a reversal here. Earlier, I was watching the overnight markets here, and the dollar was weaker, but now the dollar is a little bit strengthening, but nothing major against the other larger currency pairs, but 91.04 dollar index. Bitcoin is currently at $38,700 per coin. Overnight futures trading for the Dow Jones Industrial Average and the S&P 500 are both in the green, up 0.4%. NASDAQ 100 is up 0.6%. Japanese cash trade is up 1.9%. The Nikkei Japanese exchange is at a 30-and-a-half-year high. 30-and-a-half-year high on the Japanese exchange. Still a long way to go, about 30% to get back to their all-time high back in 1989. So it's been over 30 years, as I just stated, since we've been to that point. It was a lost generation, probably lost generations, plural. And that's the same situation that's going to happen in Europe, already underway, and the same process that's going to happen here in the United States as well. That's also underway. And then we have the Australian cash trade putting on a gain of about 0.8%. Chinese stocks are also up 1.2%. And the Indian exchange is up 1.4%, with the Indian market at 51,400 points. I mention this because only a couple weeks ago there was basically a 10% correction, and fast forward to where we are today, it's hitting an all-time high. The previous all-time high, when I mentioned that on that podcast, was at about 50,000 points. So we're blowing through all of this stuff. This is what happens when you print money. And don't forget, last week we discussed the change to M1 money stock, and of course hit a new all-time high. So is it any coincidence that money stock continues to hit all-time highs, and we still have the stock market hitting all-time highs as well? On the commodity front, WTI is at $57.49 a barrel, Brent at $59.99, so almost at $60 per barrel. That's exactly what we want, folks. We want all of the input prices that we use to do everything to keep going up while we still have tens of millions of Americans unemployed. And, extrapolate that globally, because these are global commodities. Oh, there we go. $60.02 a barrel Brent. Fantastic. Natural gas, $2.94. Gold regaining that 1,800 handle, $1,813 an ounce. Silver at $26.99, flirting with that 27 handle once again. And on the bond front, we have Uncle Sam's 10-year junk note at 1.19%. Has not been this high since last March. We talked about this too briefly last week. This is something to keep an eye on, because I do not believe that the bond market is pricing in economic growth. I think they are pricing in the effects of inflation. And so we are getting this rise of inflation because that's what the Federal Reserve and other central banks have done. They have created inflation by the very fact that they have expanded the money supply. That is the definition of inflation. But this is now running counter to what the Federal Reserve really wants. Now, they'll say they can tolerate higher rates of inflation, but they want lower interest rates. So this is a neat trick that they have to pull off. The markets are saying, inflation is starting to come in. It's already been here, but now they can't even suppress it. And of course, when it comes to those core numbers that they look at, they extract, they remove energy costs and food costs. I'm not making this stuff up. That's how they calculate it. They remove it. The two goods that everybody needs to survive, food and energy, are removed from their calculation. Now, it's still there in another calculation, but that's not the one that they look at. Can't make this stuff up. Anything to suit their purpose. But you have the Fed that's going to end up fighting inflation with more inflation because they're going to have to print more money to go out onto the bond market across the yield curve to buy more debt to push down those yields. Bid up the price, higher price, lower yield. They are trapped. They have been trapped. It's just a matter of time before everybody wakes up to this and says they're out of ammunition. This is no longer going to work. And the system is just going to exhaust itself. And when that day comes, I don't know when it's going to be, but it will. Because it's basic math, it's basic economics. It's going to be devastating. It's going to end in blood and tears. But there you have it, 1.19%, Uncle Sam's 10-year junk note. Now to the January jobs report. The unemployment rate fell by 0.4 percentage points to 6.3% in January, while non-farm payroll employment changed little, an additional 49,000. The labor market continued to reflect the impact of the coronavirus pandemic and efforts to contain it. In January, notable job gains in professional and business services and in both public and private education were offset by losses in leisure and hospitality, in retail trade, in healthcare, and in transportation and warehousing. All right. Household survey data. In January, the unemployment rate fell by 0.4 percentage points to hit 6.3%, and the number of unemployed persons decreased to 10.1 million. Although both measures are much lower than their April 2020 highs, they remain well above their pre-pandemic levels in February of 2020. Among the major worker groups, the unemployment rates declined over the month for adult men 6%, adult women 6%, whites 5.7%, and Hispanics 8.6%. The jobless rates changed little for teenagers at 14.8%, blacks 9.2%, and Asians at 6.6%. Among the unemployed, the number of persons on temporary layoff decreased in January to 2.7 million. This measure is down considerably from the recent high of 18 million in April, but is 2 million higher than its February level. The number of permanent job losers at 3.5 million changed little in January, but is 2.2 million higher than in February. So this has been somewhat plateauing, but a slight increase month over month, something we still want to pay close attention to, that level of permanent job losers at 3.5 million. The number of reentrants to the labor force decreased in January to 2 million. Reentrants are persons who previously worked but were not in the labor force prior to beginning their job search. In January, the number of persons jobless less than 5 weeks decreased to 2.3 million. The number of long-term unemployed, those jobless 27 weeks or more, at 4 million was about unchanged in January and accounted for 39.5% of the total unemployed. That's just not a good number at all. Those jobless more than 27 weeks is at 4 million, representing almost 40% of total unemployed. Not good. After accounting for the annual adjustments to the population controls, both the civilian labor force and the number of employed persons changed little in January. At 61.4%, the labor force participation rate was about unchanged over the month, but is 1.9 percentage points lower than its February level. These are the deeper numbers when it comes to some job statistics, and we have not seen much movement here at all. And that's just in better alignment with what we're seeing on a week-by-week basis with respect to initial jobless claims. So 61.4% is not a good number. The employment population ratio at 57.5% in January changed little over the month, but is 3.6 percentage points lower than in January. Lower than in February, last February. The number of persons employed part-time for economic reasons at 6 million changed little in January. This measure is 1.6 million higher than the February level. These individuals who would have preferred full-time employment were working part-time because their hours had been reduced or they were unable to find full-time jobs. The number of persons not in the labor force who currently want a job at 7 million edged down in January, but is 1.9 million higher than in February. These individuals were not counted as unemployed because they were not actively looking for work during the last 4 weeks or were unavailable to take a job. So there's a lot of people who left the labor force, unfortunately, and that's why we continue to see the quote-unquote official jobless rate continue to decline. It really doesn't tell the full picture. The number of persons marginally attached to the labor force at 1.9 million decreased in January. These individuals wanted and were available for work and had looked for a job sometime in the prior 12 months, but had not looked for work in the 4 weeks preceding the survey. The number of discouraged workers, a subset of the marginally attached who believed that no jobs were available for them, was little changed over the month at 624,000. There's some supplemental household survey data you can go through if you would like. Again, this is on bls.gov, Bureau of Labor Statistics. On to the establishment survey data. Total non-farm payroll employment changed little in January, a gain of 49,000, but is below its February 2020 level by 9.9 million, or 6.5%. In January, notable gains in professional and business services and in both public and private education were offset by losses in leisure and hospitality, in retail trade and healthcare, and in transportation and warehousing. In January, employment in professional and business services rose by 97,000, with temporary help services accounting for most of the gain, up 81,000. Job growth also occurred in management and technical consulting services, up 16,000. Computer systems, design and related services gaining 11,000, and scientific research and development services gaining 10,000. These gains were partially offset by job losses in services to buildings and dwellings, losing 14,000, and in advertising and related services, negative 6,000. Since February, employment in professional and business services is down by 825,000. In January, employment increased in local government education by 49,000, state government education gaining 36,000, and private education gaining 34,000. In both public and private education, pandemic-related employment declines in 2020 distorted the normal seasonal buildup and layoff patterns. This likely contributed to the job gains in January after a seasonal adjustment. Wholesale trade continued to add jobs in January, up 14,000. However, employment in the industry is 263,000 below its February level. In January, employment in mining increased by 9,000, with a gain of 8,000 in support activities for mining. Mining employment is down by 133,000 since a recent peak in January of 2019, though employment in the industry showed little change for several months prior to the uptick in January. Last month, employment in leisure and hospitality declined by 61,000, following a steep decline in December, losing 536,000. In January, employment edged down in amusements, gambling, and recreation, losing 27,000, and in accommodation, minus 18,000. Employment in food services and drinking places continued to trend downward, losing 19,000. These are your restaurants, your bars, your small businesses. They continue to get decimated. Employment in leisure and hospitality fell by 8.2 million during March and April, increased by 4.9 million from May to November, and then declined by 597,000 over the past 2 months. So you get your little V-shaped miraculous recovery here in some of these sectors, only to have it roll over. You can print money, it can fill a void for so long, and then economic reality takes hold. That's what we continue to monitor here. Since February, employment in leisure and hospitality is down by 3.9 million, or 22.9%. Retail trade lost 38,000 jobs in January after adding 135,000 jobs in December. Of course, a lot of this is seasonal shopping. Over the month, employment declined in general merchandise stores, minus 38,000, electronics and appliance stores, minus 29,000, and non-store retailers losing 15,000. These job losses were partially offset by gains in food and beverage stores, up 15,000, clothing and clothing accessory stores also up 15,000, and health and personal care stores up 14,000. Employment in retail trade is 383,000 lower than in February. Employment in healthcare declined by 30,000 in January, with the industry. Job losses occurred in nursing care facilities, losing 19,000, home health care services losing 13,000, and community care facilities for the elderly losing 7,000. Since February, healthcare employment is down by 542,000. With respect to transportation and warehousing, employment declined by 28,000 in the month of January and is 164,000 lower than in February. In January, job losses occurred in warehousing and storage, minus 17,000, and in couriers and messengers, minus 14,000. However, employment in these industries is higher than in February by 97,000 and 137,000, respectively. Employment in air transportation increased by 15,000 over the month, but it's 105,000 lower than in February. So this is sort of obviously the Amazon effect, if you will. People are not allowed to go out, or at least they're not allowed to go to those smaller businesses. Just the process of consolidation. So, well, you're going to have to work in a warehouse. You have to be in the distribution sector. You're going to have to work in as a courier, and that's what we've witnessed, and that's why we continue to see, these numbers with respect to transportation and warehousing rebound and are higher than where we were last year. The question is this the new normal? Will this sustain itself, or is this also just a function of a lot of this quote-unquote free money being thrown at us, and they're spending it? So once that dries up, if it ever dries up, will that have an adverse effect? It should. Employment in manufacturing changed little over the month, minus 10,000, following 8 months of growth. Within the industry, durable goods lost 17,000 jobs in January. Employment in manufacturing is up by 803,000 since April, but is 582,000 lower than in February. Now, they say changed little over the month with respect to manufacturing losing 10,000. I don't like how they worded that. That's a little bit more than little. It's somewhat significant, because I think if it was a gain of 10,000, I don't think they would have said it changed little over the month. But that's just my nitpicking there. Construction employment changed little over the month, losing 3,000 after increasing for 8 consecutive months. However, employment in the industry is down by 256,000 since February. In January, employment changed little in other major industries, including information, financial activities, and other services. Last month, average hourly earnings for all employees on private non-farm payrolls increased by 6 cents to $29.96. Average hourly earnings of private sector production and non-supervisory employees at $25.18 changed little, a gain of 3 cents. The large employment fluctuations over the past several months, especially in industries with lower paid workers, complicate the analysis of recent trends in average hourly earnings. Well, then stop giving us the average hourly earnings and give us the median hourly earnings, or at least give us both to tell us where we stand. The average work week for all employees on private non-farm payrolls increased by 0.3 hours to 35 hours even in January. In manufacturing, the work week also increased by 0.3 hours to 40.4 hours, and overtime was unchanged at 3.2 hours. The average work week for production and non-supervisory employees on private non-farm payrolls increased by 0.2 hours to 34.4 hours. The change in total non-farm payroll employment for November was revised down by 72,000, from a positive 336,000 to a positive 264,000. And the change for December was revised down by 87,000, from a negative 140,000 to a negative 227,000. With these revisions, employment in November and December combined was 159,000 lower than previously reported. Monthly revisions result from additional reports received from businesses and government agencies since the last published estimates, and from the recalculation of seasonal factors. The annual benchmark process also contributed to the November and December revisions. So that's not good. Over the past 2 months, we see a combined decrease of 159,000. But at least that is still in agreement, if you will, with some respect to the initial jobless claim stress that we continue to see week over week over week. A few short weeks ago, we were at 900,000, north of 900,000. That's not what's supposed to be happening here if we are really experiencing an economic revival here. We continue to see the stock market, and almost one stock market after the next globally, continue to hit all-time highs or get close to all-time highs. The disconnect is startling. The disconnect is insulting. And the day of reckoning will come. I would like to see that the economy can grow to keep pace, to justify these types of valuations, especially in respect to the equity market, but it's just not going to happen. And that's just being honest. That's just being realistic. It's called math. It's called economics. We know at current rates what our national debt's going to be. We know at current rates what our GDP is going to be over the next 4 years when we talk about the U.S. debt clock. $7 of debt for $1 of growth. 7-to-1 ratio. That's completely unsustainable. It's completely irresponsible, immoral, unethical, and un-American. But that's what we're going to do. And quite honestly, it's probably going to get worse than that. Because this $1.9 trillion monstrosity that the Biden administration and Democrats want to push so heavily, in some form or another, it's going to get passed. And then there'll be another one. And yeah, they could do it through reconciliation in the Senate, just getting 51 votes, all it takes. And it's probably not going to be in one shot at $1.9 trillion, but a couple $100 billion here, a couple $100 billion there, a few $100 billion here. Before you know it, we'll be at $1.9 trillion and probably exceed it. And that's just on this measure. That's just on COVID-19. That's on perhaps giving assistance to opening schools or what other BS they want to sell us, the stimulus checks to Americans, blah, 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 blah. Then what's going to come down the pike afterwards? Something with respect to the climate crisis, right? Because you can imagine that President Biden at some point is going to declare a climate crisis too, just like the Prime Minister down in New Zealand did. Oh, we eradicated COVID-19. We're the best. We did everything. Now it's on to the next crisis, and declares an emergency crisis. So don't be surprised if that takes place here in the United States. And then, of course, that's going to be the catalyst to push some more spending to take care of the climate crisis. Well, how many billions, hundreds of billions, if not trillions, is that going to cost us? Then the Democrats are in control, of course, so they're going to have to do something with health care because it's never enough. So how many more billions are they going to spend there? Then they might finally get around to talking about infrastructure and might spend some more money there. Do you get it? You understand why I say the Federal Reserve's balance sheet at $7.4 trillion now, a record high basically, flirting with a record high which we hit a couple weeks ago, is going to be at $10 trillion in the not too distant future, most likely by the end of this year, and it could well be above that. And again, some perspective with respect to the Federal Reserve's balance sheet before the great financial crisis, it was at $800 billion. From their inception, 1913, 1914 to 2008, $800 billion. We're now at $7.4 trillion. Okay? This is an economy. This is a society in decline, in decay, in collapse. We are a first world banana republic. If these policies work so well, we would never have any type of market correction. We would never have a recession. We'd never have any type of economic hardship. All we would have to do is print more money. If that was the solution, as I say here all the time, the real banana republics of the world would not be banana republics. They would be the poster children of what you're supposed to do, of how you're supposed to manage and run your economy. We would be taking notes from Venezuela and Zimbabwe and Argentina, but we don't. We don't, because those policies do not work. Because we're the largest country in the world, because we're the largest economy, because we have a very powerful military, because the dollar is the reserve currency, that buys us time, but that's all it does. It buys time. And we sacrifice the long term so we can live it up in the short term. That's also math. We could have set policies in place to allow time and compounding interest to work for us. Maybe a little bit of sacrifice in the short term for the benefits of the long term, but no, we did the complete opposite. Instead of having real economic growth, perhaps GDP 4 years from now at $49 trillion, we're now going to have a $49 trillion national debt. It could have been the other way around. We could have had a national debt 4 years from now at $20 trillion, $24 trillion, which still would have been too much, but it would have been 50% of our GDP. Much more reasonable, much easier to handle, much easier to manage. We shot ourselves in the foot. We have nobody to blame but ourselves for all of this, and we're all going to pay for it. But obviously my biggest concern, one of them anyway, is the fact that we're pushing it off for future generations to deal with it, to really face the biggest of the costs. And that's just immoral. It's unethical, and it's un-American. We should not be doing it, but people don't care. People want to say it's about the children, it's the children's future. They're screwed. You don't care about them. You don't care about your children or your grandchildren. You wouldn't have done half the things you've done. You wouldn't have voted for half the things you voted for if you did. I mean, your ignorance is your problem, especially now with the information age. You have the world at your fingertips. Read a book. Get educated. Don't fall into the trap of the two-party system. Coke or Pepsi, Coke or Pepsi. There's no such thing as iced tea, lemonade, water, nothing. That's it. That's your flavor of the month, flavor of the year, flavor of the 4-year administration. That's it. And you keep falling for it. We made these problems. I'm still somewhat hopeful and optimistic that we can solve them, but that window is getting smaller and smaller by the day. But there you have it. That is the January 2021 jobs report. We'll see what this week brings us. I found some surveys with respect to average and median savings. Maybe we'll have that conversation later this week. But there you have it. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Corritis. Godspeed.